Hello, and thank you for joining us for today's Scientific Beta webinar. I am Séverine Sibeli from the marketing team at Scientific Beta. Today, we will be presenting several articles from the latest EDEC research for institutional money management supplement to pensions and investment. First, a presentation on examining the robustness of various smart beta strategies by Dimitris Korovilas, investment specialist at Scientific Beta. Then a presentation on intangible assets and the value factor by Felix Goltz, Research Director at Scientific Beta, who will be joined by Bell Newton, Quantitative Research Analyst at Scientific Beta. The third presentation will be on ESG Engagement and Divestment and made by Erik Christiansen, ESG and Low Carbon Investment Specialist at Scientific Beta. And finally, Daniela Gay, Index Director at Scientific Beta, will be speaking about the benefits of the historical volatility adjustment risk control option. If you have a question on any of the topics, you can either use the Q&A function or the raise hand sign at the bottom of your screen. We will address the questions at the end of each session. So I will now hand over to Dimitris for the first presentation. Thank you.
Thank you, Séverine. Welcome everyone on the call. So let me try to get control of the presentation. So exactly, yes. So the first presentation today is about the topic of robustness in multi-factor strategies and smart beta strategies. And we are examining the subject of why robustness is important for investors, why it is particularly important. And the reason this is true is because we observe in the marketplace, we observe strategies often falling into a situation where they have an out of sample degradation of performance. That's a common feature, or they start to behave differently from what the investment objectives of the strategy were supposed to be. So given this disparity in the marketplace, we examine what are the common sources that lead to a lack of robustness, which is the reason behind this problem in these strategies. And on top of presenting these common features, we also offer the equivalent methods by which Scientific Beta operates in the index design phase and improves robustness. Now, if you put robustness in the forefront of your index design, what you get is especially in the factor space, you get indices that benefit from what we call good factor exposure quality. And what this is a good combination of strong factor intensity, but also a good factor diversification. So you get your benefits of investing in factor premia from as many sources as possible. And this essentially is your ticket to a good out of sample robustness, good potential for out of sample outperformance, because this way you can reduce strong dependencies. For example, in strategies that essentially invest in a few factors only, you depend really on whether the particular factor will perform well in the sample or not. Now, on top of the theoretical discussion of what is these problems with robustness, we also try to offer investors a tool set of robustness measurements. And this is important because sometimes identifying robustness issues may not be straightforward. So a quantitative tool set is always useful to assist investors in their evaluation of strategies. And in this paper, on top of presenting these measurements, we also have a case study applying these tests into popular strategies in the marketplace. And we try to see whether problems we identified in the design phase also pop up through the quantitative examination. So In this slide, there is a summary of starting from the left-hand side, there's a summary of common sources of lack of robustness in multi-factor strategies. In the middle column, there is a representative example of these problems in popular strategies in the marketplace. And then on the right-hand side, you have the equivalent method by which robustness can be improved. And this is what we apply at Scientific Beta. So common sources of lack of robustness can be categorized between problems with factor definitions, problems with model mining, problems with increased exposure to unrewarded risks, or issues with, as we said already, with strong dependency on a few factors rather than a factor diversified approach. For example, in the category of factor definitions, we can see strategies often falling into the trap of factor fishing or going after redundant factors. And these problems fall into the general, and these problems can be easily, let's say, resolved on the right-hand side if you follow simple, univariate, parsimonious factor definitions. And most importantly, definitions that are backed by economic rationale, because in that case, you have an alignment of the way you create your factor strategy and the reason that the factor premium exists in the first place. And this is very important for the out-of-sample performance of your factor strategy. In other cases, we have problems like factors defined with a complex and usually composite variable approaches, whereby an in-sample performance may be strong, but when you move out of sample, given that the definition doesn't align with the reasoning for the factor to exist, you see problems in the performance. So similar problems, for example, with the unrewarded risk, you have strategies that very easily focus on stock level characteristics to weight their portfolios. This can create concentration. This can introduce unrewarded risk, idiosyncratic risk, which are unrewarded very easily. For example, the solution to this is to apply well-diversified portfolios. And this aligns also with the academic justification for factors, which if you look at the asset pricing literature, the definition of factors on top of the economic rationale comes in the form of broad-based portfolios. So not concentrated portfolios, not overweighting particular stocks if they have a higher factor score, etc., but rather creating diversified portfolios that offer you the broad exposure to the factor premium. So these are just some examples. Now, on the interest of time, I will move also to the quantitative side. So, as we said, measuring robustness is also important, and our robustness tests have a set of categories that they look at. The most important one, the first, is looking at factor exposures and measuring the factor exposure quality of the particular strategy. And factor exposure quality is simply the product of factor intensity and factor deconcentration. So what you do is you try to see if your strategy is diversified from a factor perspective and how strong your factor betas are. And you can see in practice that many strategies that are sold under the umbrella of multi-factor, essentially, when you measure factor exposures, you see that they are more or less exposed to, let's say, to a couple or maybe 3 factors, some more, some less. So in reality, if you look here at the average numbers, you can see strategies popular multi-factor strategies with an average factor deconcentration of around 3, which is much lower than the one you observe from the scientific beta indices. And the reason these scientific beta indices have this higher deconcentration and factor intensity, which at the end results into a better factor exposure quality, the reason is that when the multi-factor indices are constructed, you have a combination of single factor sleeves, and these single factor sleeves employ what we call the HFI filter. And this HFI filter is simply aiming to remove from each factor sleeve, to remove the negative exposure to all the other rewarding factors. So in essence, when you combine these efficient single factor sleeves into a multi-factor product, you achieve this good balance of factor betas. And this essentially is a very good step for robustness, because out of sample, you don't know a priori which factor will perform well and which one will not. Because we know that factor premia are time varying and they may perform well in different economic conditions. So from an investor point of view, and then in particular from a long-term investor point of view, a balanced strategy across factors is the robust approach for outperformance. In a different scenario, what you get is either being lucky and your concentrated strategy performs well because a factor performed well in that particular sample, or the other way around, you may lag behind a lot in performance if you are invested in or concentrated in the wrong factor. And then some more output from our robustness tests. Other dimensions that we examine is conditionality to different economic conditions. We also calculate rolling statistics for outperformance, and this helps you remove the strong dependency on a particular entry and exit point. Is a rolling measure which takes into account all possible entry and exit points. We also look at extreme statistics, so you can see how your tracking error or your volatility measures jump in extreme situations. And finally, we have a Sharpe ratio test, whereby you have an econometric test to tell you whether the in-sample Sharpe ratio difference is significant or not. So these are all useful tests that help investors identify potential issues with their strategy. So to sum up, in this paper, we examine competitor multi-factor strategies through the lens of our robustness test. We find that problems identified in the design phase also pop up in the measurement phase, and in particular, you see scientific beta indices having much stronger factor intensity and factor exposure quality. And in the paper as well, you see a list of all the common sources of lack of robustness, and then on the second part, you see the explanation of the robustness measurements and accompanied results. And with this, Severin, I will conclude here.
Thank you very much, Dimitris, for your presentation. We have received one question. You highlighted the need for simple factor definitions that align with the economic rationale of a factor. Which factors do you use and how do you define them?
Yes, so on this topic, the factors we use are 6 well-rewarded factors that have been justified in the asset pricing literature, and most popular asset pricing models use a combination of these factors. So the 6 factors is the size factor, the value factor, the momentum factor, the low volatility factor, and the low investment and high profitability factor. And as I explained at the beginning, we try to define these factors with a parsimonious, simple definition aligned with the economic rationale. So, for example, the value will be defined with an intangible-adjusted book-to-market ratio, which goes hand in hand with the reversibility of assets definition of value. The momentum is a simple returns ranking. The low volatility is again a standard deviation calculation, etc., etc. So all the 6 definitions are aligned with the economic rationale behind the factor.
Thank you very much, Dimitris. There is no other questions, so we can move to the next presentation by Felix and Ben. Thank you.
Thank you very much. So the value factor clearly is probably the factor that historically is the most established. But recently, value has come increasingly under attack. And what's this attack? Well, the attack is simply to say the way we measure the value factor seems to be problematic because historically the measure of the value factor is the book to market ratio. So that goes back to a paper by Bar Rosenberg in 1983. And so since then, when we talk about the value factor, well, the standard definition is to use the book to market ratio. So what's the problem with book to market? Well, simply the book value relies on accounting rules, obviously, that determine what actually firms can put on their balance sheet. And unfortunately, what firms carry on their balance sheet actually just misses a lot of the investment that the firm is actually doing. So there's a lot of stuff missing from the balance sheet that actually represents assets that firms typically have. And so in particular, over the recent years and the recent decades, there has been an increasing importance of intangible assets. So the book value will mostly capture the investments into physical capital by firms and will less capture the investment into intangibles. And so this has led to claims that the book to market ratio is really outdated as a value definition. Now, 2 answers have been proposed to this problem. So one is an answer that is quite often proposed in the industry, and that is to basically move away from book to market and instead to look at other valuation metrics, so things like sales to price, cash flow to price, etc. And most often, the proposal is to combine these metrics instead of relying on book to market. Academics, on the other hand, have proposed to stay with the book to market factor, but simply make adjustments to include intangibles. So the idea is basically to kind of revisit this traditional book to market factor and just account for the intangible capital. So these are 2 different answers. So we actually studied these 2 different answers in a recent paper. So we published this in the Journal of Portfolio Management in July. So I'm joined in this presentation by Ben Luton, who's one of my co-authors, and Ben will answer questions at the end of the presentation. So how do we adjust for intangibles? Well, simply we have to look at what is missing in balance sheets and put it back into kind of adjusted book values that we actually use. And there's really 2 main items that are missing. So one is organization capital. So what's organization capital? Well, organization capital refers to the brand, the customer loyalty, the customer relationships that firms have. So you can think of, say, a typical strategy consulting firm. Obviously, organization capital, the firm's reputation, etc., will be extremely important and will be an important asset for such a firm. How do we measure this organization capital? Well, we actually have information in accounting items that allow us to estimate organization capital. So investments into organization capital, so investments into the firm's talent, into the firm's brand, will actually show up in selling, general, and administrative expenses. So we can actually use part of those expenses to actually capitalize them and then depreciate this asset over time. The second item is knowledge capital. What is knowledge capital? Well, knowledge capital is, the firm's know-how that can be protected in the form of patents, for example, but could also be, just know-how on, either production processes or know-how that helps improve products. So as an example, you could think of a biotechnology company where obviously research and development will lead to generating important knowledge capital for this firm. And so we do have research and development expenses available in accounting data, and so we can actually capitalize these, rather than expensing them, and so we can actually correct for this accounting conservatism that we have in the reported book values. Now, what happens when you follow these different approaches? So again, we're going to look on the one hand at an adjustment of the book value. So we also call that I book to price, so the intangible adjusted book to price. And we're just going to compare that to the use of alternative valuation ratios: sales to price, earnings to price, dividend to price, the cash flow to price, and then composite metrics that actually combine these four alternative metrics. Here you see the annualized factor returns. So this is in US data since the late 1970s. And you can see that a lot of the alternative value definitions actually have higher returns than book to price. Sales to price, for example, delivers about 4%. Earnings to price delivers around 3%. So that's perhaps why they are popular in the industry. They deliver higher returns than the book to price, which is around 2%. The intangible adjustment also increases returns. So we're moving to almost 5% returns. Now, simply looking at returns is really not the relevant question for an investor, because an investor is not going to allocate 100% of his portfolio to the value factor. So the relevant question for an investor is, how does that value allocation or that value factor actually contribute to my overall portfolio that will have multiple factors? So to address this question of the value added for a diversified investor, we have to look at an adjusted return, where we adjust the return by the exposure of these different value factors to other factors. Okay, so this is also called the intercept and the multi-factor spanning regression. Economically, what it means, it's simply the value added for an investor who has access to multiple factors. And we consider a standard factor menu here of 6 non-market factors, so including not just value, but also momentum, low vol, investment, profitability, and size. And so we're going to adjust the returns of these alternative value factors for all these implicit factor exposures. You see a very striking result here if you go back to sales to price and earnings to price. So on a standalone basis, we saw that these value definitions actually had a high and attractive returns, so 4% for sales to price, 3% for earnings to price. Look at what happens when you adjust for the other factors. So none of these value definitions actually delivers positive returns once you adjust for the other factors. So sales to price, for example, actually gets a negative value, but pretty close to zero. Earnings to price almost indistinguishable from zero. Even the composites that mix these different value metrics do not deliver value. There's a simple explanation for that. And that explanation is that you get implicit exposure to other factors. In particular, for many of these value definitions, you get exposure to the profitability factors. If you look at earnings to price, you get substantial exposure to the profitability factor. And so, of course, combining profitability with value is an interesting idea. But if you already have access to multiple factors, you don't gain anything by having a so-called value factor, which is actually not really a value factor, but which is actually a value plus some profitability factor. That's just going to create some overlap in your multi-factor allocation, and you're going to load up too much on profitability exposure, and you're going to do that in an implicit way. Now, these that we observe this, is also not a surprise, because if you think about earnings to price, well, precisely you would expect that companies with high profitability, will tend to have high earnings, and so will tend to have a high earnings to price as well. So there's really no value in these alternative valuation ratios. On the other hand, if we look at the intangible adjustment, we can see that there's a significant positive return, even after adjusting for all these factor exposures. So I book to price, so that's, when you add organization capital and knowledge capital back to the book value, well, then you actually get a significant value premium, even after adjusting for all the factors, and that's 2% annualized. And so the conclusion is quite clear cut in this case, and we have more detailed analysis in our paper, but very clearly we confirm that there is no value added in alternative valuation metrics such as sales to price, earnings to price. All it does is create factor overlap. On the other hand, adjusting for intangibles actually does add value. And so if we go back to this question of, well, is there, is this value definition actually outdated? So should we forget about book to market? The answer quite clearly is, book to market is actually relevant. You just have to measure it properly. And so you have to account for intangibles and not just account for physical capital. And that actually provides for a sizable value premium. Thank you very much for your attention.
Thank you very much, Felix. We received a question asking, is this somewhat self-correcting as the exclusion of intangibles should favor or be captured by the low investment and high profitability factors?
Yes, thank you for the question. I think it's we can answer this question by stressing again the fact that so we really looked at the value added to a portfolio of all these factors, which already includes other factors such as notably low investment and high profitability. So if there are questions regarding whether or not a certain adjustment actually would just lead to some sort of link to other factors, then our empirical analysis actually clearly takes this into account and clearly shows that when we use this intangible adjusted value factor, this is a factor that actually adds value over and above a portfolio that would already include factors such as low investment and high profitability.
Thank you very much, Ben. An additional question, have you tried including the intangible adjusted book to price in the composite measure?
Yes, so as Felix mentioned, we did a lot of empirical analysis in his research. So one of the tests we did is really going to look at direct pairwise comparisons between different sets of factors. So in this setting, we can take the results of the intangible adjusted book to price factor on the one hand, and then a composite factor in which we also adjusted the book values for these intangibles. And then the result that we obtain is for a multi-factor investor who has a portfolio in which the value factor is this intangible adjusted value factor. Adding such a composite factor to this portfolio is not going to create any additional investment value in terms of additional risk-adjusted return for such an investor. But then interestingly, if you look at it from the other way around, so if you start from an investor who represents his value factor with this composite value definition in his portfolio, then adding the intangible adjusted book to price factor to this portfolio actually does create this additional investment value, which again we can interpret this again by the fact that creating these composite definitions will generally lead to a tilt towards other factors which the investor already has exposure to in his portfolio.
All right, thank you very much, Ben and Felix. No additional questions, so we can move to the third presentation by Erik Christiansen on ESG engagement and divestment.
Thank you. I'll just share my screen. Give me a second. So this article was about two popular ESG strategies, ESG engagement and ESG divestment. And we wanted to look at the links between these two types of ESG strategies. And in particular, we wanted to dispel two misconceptions in that regard. The first one being that if you want to engage, or if you want to be, let's say, an active shareholder, that you would need to remain a shareholder in the company, i.e. that you could not divest, meaning that the two strategies are mutually exclusive. The other misconception is that divestment is a passive approach. Some call it a bystander approach, in the sense that once a shareholder they divest from a company, actually nothing happens in terms of ESG impact on the company. It doesn't change its behavior. It doesn't influence the way the company management behaves. Secondly, we wanted to show, actually, to the contrary, how ESG divestment actually influences company. What are the levers, the mechanisms through which divestment influences corporate behavior, and therefore enables investors to reach their ESG goals. And thirdly, we wanted to look at how other ESG strategies, so other than divestment or filtering or exclusions, which are, let's say, synonyms in this regard, how other ESG strategies, what people call sometimes ESG integration strategies, but what we prefer to call mixed up strategies, in the sense that they mix traditional financial signals with ESG signals, such as ESG scores, in the portfolio construction. And we wanted to look at how these ESG mixing strategies perform in terms of influencing companies, in terms of reaching ESG goals from an engagement point of view. So the key results, the first thing we wanted to look at is how divestment influences companies. And it's very clear from the academic literature that that happens through raising the cost of capital. And this impact of divestment on cost of capital is dual. There's, first of all, of course, the most obvious impact is that when you sell a stock, you increase the supply of a stock. So the price of the stock should be decreased, which is equivalent to saying that the cost of capital of the company increases. However, there are also a very important indirect effect, or what you could call a signaling effect, whereby if you have a public, let's say, very vocal divestment, if you, for example, participate in an investor coalition that favor the different divestment campaigns, then if you have a vocal, public, broad divestment approach, you can actually participate in the process of creating new societal norms, which basically threatens the social license to operate of companies that are divested from. And this increases their riskiness. So basically you're sending a signal which increases the riskiness of companies, and therefore quite rationally the required rate of the return, which is basically the cost of capital of companies, should also increase through a signaling effect, which is very important. And we'll stress this again today. We also show that divestment and engagement are not mutually exclusive. So as I said, it's very often claimed that you need to remain a shareholder in the company in order to be able to have a dialogue with the company, to engage with it. And this sounds a bit obvious. It sounds like you need to be a shareholder to be an active shareholder. However, this is clearly not the case for public listed companies, where shareholderships are typically very dispersed and evolving over time. There's a high level of transactions in the market, so shareholders change a lot. And if you have such a public market, there is no reason to believe that sellers of equity capital, so sellers in the market being companies, should refuse to talk to prospective buyers. They will, of course, be willing to talk to their current clients, let's say, their current shareholders, but there's no reason to believe that they should refrain from also talking to prospective buyers, future shareholders or potential shareholders. And this can be seen in practice. So this is a theoretical argument, but it can be seen very clearly also in practice, in investor coalitions, and where current shareholders and also potential shareholders meet up, they join their forces to engage with companies. And beyond being mutually not exclusive, so compatible, the two approaches are actually mutually reinforcing. So first of all, if you want to engage with the company, so basically you want to enter into kind of a negotiation with the company where you try to make the management change its behavior. So in such a negotiation, you should have a clear bargaining position. And if you don't even have the possibility, at least the possibility to exclude the company if the counterpart in the dialogue doesn't meet your conditions, then of course you are entering into dialogue through a very weak bargaining position. And also, as I said, it's clearly mutually reinforcing in the sense that being very public about your divestment actually changes societal norms. It changes the expected riskiness of companies, and therefore raises the company's cost of capital, and therefore gives an incentive to the company to actually change its behavior. And last point here is that from that point of view, from the point of view of signaling, of having an effective engagement, the benefit of having a divestment approach, so a filtering approach or exclusion approach again, so you just basically sell those companies which don't meet your strict requirements, that sends a very clear signals because it's clearly understandable. There's no ambiguity in it. You can very clearly understand how your decision impacts your portfolio decision in terms of selling decision. There is no, for example, financial override of your ESG signal. There is no chance that, for example, the financial attributes of a company could be so good that even if the ESG performance is low, that you might still have it in the company, which would be a very ambiguous signal. Divestment is on the clearly a very clear signaling effect. That's the probably the main benefit of divestment from an engagement point of view. Now, as I said, we looked at other strategies in terms of how effective their engagement is, and we looked at some ESG integration strategies or mixed strategies where you mix a financial characteristic with an ESG characteristics in the portfolio construction process. And in this slide here, we show probably the most simple example of such a mixed up approach, where we combine two signals. One is the market cap, the most basic financial signals, and we take a carbon intensity metric from an ESG perspective. So carbon intensity being here the carbon emissions divided by the revenues. And so the weight of the company, the more less carbon intensive it is, and the higher the market cap, the higher the weight in the portfolio. And what we see here in terms of signaling is, and here we look at stock level signals as opposed to the overall global signal, because if you build the portfolio in this way, you will achieve an overall carbon intensity reduction. So the weighted average carbon intensity of such a portfolio is indeed improved relative to, let's say, a broad market benchmark. So the overall goal is reached, but if you look at what happens at stock level, the signal is much more ambiguous. And in the middle column here, we look at what happens to what we call the deteriorators, meaning companies whose carbon intensity worsens from one year to the other. And we can see that while the carbon intensity worsens, the weights can actually increase. Almost half the time this happens, that companies can actually have a higher allocation in the portfolio, even though they've actually worsened from an ESG perspective. So this, of course, is completely contradictory with the stated goal. So if you are an investor and saying, I want to be low carbon, I want to be, let's say, climate friendly, I want to participate in the mitigation of climate change, if that's your overall goal, which you have actually achieved, what happens when you talk to a company and they will look at what you do at portfolio level, you might actually almost half the time have increased the allocation to the company, even though it's performed contrary to what you expected it to do in terms of carbon intensity. We also look at, in the right column, what can happen with the very worst companies in terms of carbon intensity. So here we look at the 10% worst carbon intensive companies. And we can see that even for those companies, so the real bottom companies in terms of ESG performance, they can also from one year to the other have an increased allocation. So again, this is contrary to the stated goal that you want to allocate companies to, let's say, the good performing companies from a climate perspective. What you're actually doing is you can increase the allocation to the worst carbon intensive companies. Now, in this slide, we look at slightly more what some people would consider a slightly more sophisticated ESG mixing approach. But we'll see that these sophisticated approaches come with at least the same level of problems in terms of the clarity of the ESG signaling. And what we have built here is a portfolio that uses an optimization technique. And here it's a low carbon multi-factor portfolio. So we try to maximize the multi-factor exposures value, for example, which Felix and Ben talked about earlier, and other factors such as momentum, etc. So we build a portfolio where we maximize the multi-factor exposure or the multi-factor score, which we combine with a low carbon score. So it's a composite carbon, multi-factor carbon score. We maximize that score given a certain level of tracking, and we compare, we want to, in order to have comparability, we compare that to, we impose a tracking, expected tracking error to be similar to what you could achieve through a filtered multi-factor approach. So where you take away the most carbon intensive companies and you build a multi-factor portfolio within a filtered universe. So in this optimized approach, what happens, and we see a quite similar picture to what we have, what happened in the previous slide, we can see that if you look at the worst emitters, the 10% worst companies, their weight in the portfolio can also increase from one year to the other. It varies a bit over time, but it can be sometimes much more than half of the companies where, let's say, for example, an increase in the factor score from one year to the other could lead to an increase in the weight, even though the carbon intensity score has been reduced. So basically, the multi-factor score can trump the carbon score if you mix them together. You can also see that in the right column that the weight of the worst carbon intensive companies can actually be higher than a cap weighted benchmark. So you claim that you want to allocate your money to companies which perform well from a carbon perspective, but you're actually over allocating to some of the very worst ones. And this can happen also from time to time. So again, what happens at stock level in this optimized or so-called optimized portfolio, what happens at stock level can be in complete contradiction with the overall stated goal. And therefore, if the investor wants to have a credible engagement with the company, and the company actually bothers to look at what happens in the actual portfolio, you probably won't have a very successful dialogue or a very successful engagement with the company management. So in conclusion, I think the most important thing to get out of this is that when the investor thinks in terms of ESG impact, and in particular how we can reach its ESG impact through engaging with companies, they need to go beyond an overall stated goal, an overall policy. They need also to go beyond overall aggregated measures of performance. So for example, an overall carbon intensity score, which is a necessary thing. So if you want to have an impact on climate change, you need to reduce overall the carbon intensity, but that's not sufficient. The signals to actually look at how effective the engagement process is, you also need to look at the signals that are sent at stock level. And in that perspective, the divestment actually sends very clear signals. It's very unambiguous, it's predictable, so it's something that companies easily understand and can act on, and there is no chance of there being a sort of contradiction between the overall stated goal and what happens at the stock level in your portfolio. So that's one of the benefits of divestment, is the clarity of what happens at stock level. And we have seen examples of the opposite approach. So let's say mixed up approaches where you try to combine ESG and financial signals, and this can lead to very contradictory decisions and therefore contradictory signals at stock level. So contradictory meaning being completely contradictory with your overall stated goal, and even potentially with the overall performance of the portfolio, for example, in terms of average carbon intensity. So investors need to go a bit beyond what happens at the overall portfolio level to actually think about how impactful an ESG engagement policy actually is. So that's it. Now we can take some questions if there are any.
Yes, thank you very much, Eric. We received a question, actually 2 questions from the same person. So in reading your article, I came to the conclusion as being that investors still have a long way to go in terms of putting an end to harmful environmental practices. Can you please provide some insights into how long you anticipate it will take for institutional investors to truly shift their focus to being ESG forward? So that's the first question. And then a follow-up question, how long will it take for retail and institutional investors to be able to capture some of these benefits?
Okay. How long it will take? I think
the sooner the better.
The sooner the better. I can't say in a number of years, but I think one interesting point is the difference between what's happening in Europe and what's happening in the US market. So let's say the two of the biggest, or US being the biggest capital market, in Europe potentially the second, or also very important capital market. We see a big the divergence, and in Europe we see a massive flow into, for example, low carbon strategies. And if you look at Scientific Beta's clients, which are mostly pension funds. So of course, pension funds are not the only investors in the overall market, but they are big players, big institutional players. We see that the clear majority of European pension funds are actually already investing in such the low carbon strategy. So the actual flows are actually already driven in the sense that we are looking here, and then this can actually have an impact on companies. In the US, it's they're slightly behind for regulatory reasons. So it's more difficult for pension funds, for example, in the US, to engage in ESG investment strategies. And let's say the regulator and the political environment up until now, at least, has been more skeptical about ESG investing. But if that changes, and if we see US investors moving in the same with the same speed that European investors, we can see quite quick changes. And I also want to stress that even though some of the papers on, for example, a link between divestment and cost of capital are quite theoretical, there are at least 2 papers which have looked at the empirical impact of divestment. So the empirical impact of these divestment campaigns and movements on, first of all, on the cost of capital, and also to some extent on the carbon intensity of companies. So one paper looked at fossil fuel divestment announcements. So when I say announcement, that clearly looks at this signaling effect more than the direct selling effect, because what is measured in this type of event study is the announcements, which is basically the time at which the signal is giving to the company, not the time at which the stocks are actually sold. And for fossil fuel divestment events, there's been shown a significant impact on the prices of stocks, therefore the cost of capital. And also a more recent paper looked at decarbonization decisions of US mutual funds. So this is not, let's say, pension funds, which we are more in direct contact with, but if you look at mutual funds in the US market, so this could be a higher share of retail investors in some of these mutual funds, for example. This paper, which was published this summer in the US market, showed that basically when there was a number of US mutual funds decarbonizing, so selling out of the most carbon intensive stocks, it did have not only a temporary impact on prices, but a lasting effect on stock prices and therefore on cost of capital. And it also showed that the companies affected actually over the next year or 2 actually decreased their carbon intensity and decreased their carbon emissions. So they actually acted on this. So when they saw basically that their cost of capital increased, they decreased the carbon intensity, which is, let's say, a logical reaction to this cost of capital. And this, so that was a very interesting first paper, which was published this summer, that actually demonstrated empirically that even in the US markets, and even for mutual funds where there is significant share of retail investors, that it does actually work and it does have an impact on the carbon intensity of companies. For example.
All right.
Yeah.
Thank you. Sorry?
No.
Okay, thank you very much, Eric. We will now move to the last presentation by Daniel Agay.
Thank you, Séverine. So let me share the presentation. Okay, so the article was on the historical volatility adjustment, which is a new risk control option that we offer since the beginning of the year. And we wanted to show the benefits of controlling volatility. So first, Scientific Beta offers a lot of risk control options because when you invest in factor strategies, investors are exposed to implicit risks or hidden risks that could affect the short-term performance of factor strategies. So these kind of hidden risks are sector risk, so sector deviations compared to the cap weight index, market beta gap risk, which means that on average, the market beta of the factor strategy is below 1, and the one that we want to discuss today, volatility risk. So each of these hidden risks need to be explicited, and investors need to know that when they invest in factor strategies, they will be affected by this risk. And so we offer ways to control for this risk. So the big difference between volatility risk control option and the sector or market beta adjustment risk control options is that sector and market beta adjustments, they will reduce tracking error compared to the cap weight index, while the volatility risk control adjustment is more an absolute risk control options, where you try to where you will have a much higher tracking error compared to the sector risk or market beta risk control options. So these different risk control options provide different level of risk control, and obviously you will have different behaviors of the index when you apply these control options. So why volatility risk is important? Well, when you look over the long term, over more than 45 years, if you look at the average volatility of a factor strategy, you see that it's close to 15%, which is slightly below the cap weight index on the same period. But when you look at 1-year rolling volatility, you see that you might experience considerable deviations from the long-term average. So this is what we call volatility risk. And so the objective of the historical volatility adjustment control option is to reduce these deviations that are below the average volatility or deviations that are above the average volatility. And controlling for volatility has many benefits that are documented in the academic literature. So the first main benefit is downside risk reduction. So when you reduce exposure in a high volatility market regime, well, you will tend to reduce exposure to strong negative returns. So you have a downside risk reduction effect. The second effect is the risk-adjusted performance improvement over the long term. Different papers show that when you control for volatility, you can improve this risk-adjusted performance for the same reason. So you reduce exposure to negative returns in high volatility market regimes. And the last one is a better conditional dissymmetry of the market beta. So what do we mean by conditional dissymmetry? Well, it's quite simple. So in high or low volatility market regimes, if you look at the market beta of a standard multifactor index, you will see that in high volatility market regimes, the market beta will be slightly higher than in the low market regimes. Well, when you control for volatility, you will have a completely dissymmetric market beta. It means that in low volatility regimes, you will have a higher market beta than the factor strategy. And in high volatility market regimes, you will reduce the market beta well below the average market beta of the factor strategy. So this conditional dissymmetry is something that is really interesting when you control for volatility. So when you want to forecast when you want to control for volatility, you need to forecast volatility, obviously. So what we do is that we rely on a statistical model, which is a Garch model that has some economic rationale because the model captures stylized facts of financial returns. So we control for, we capture volatility clustering, which means that when volatility is high, it tends to stay high in the following days, and vice versa. When volatility is low, it tends to stay low in the following days. We capture leverage effects. Leverage effect means that a negative return has more impact on volatility than a positive return. We capture the fat tail of distributions of returns, which are non-normal, and we capture structural breaks. So volatility can be impacted by strong shocks like the financial crisis of 2008 or the COVID crisis. And you need to take into account these shocks to produce good volatility forecast. And so in the table in this slide, we compare our model, which is the JGR Garch. It's a specific types of Garch model, which is used to forecast volatility. And we compare this model to more standard approach like historical volatility, EWMA, or the VIX measure. And when we compare these four different models, we can show that our model produces more accurate volatility forecast on average or in extreme situations. Okay, now how does this HVA risk control option works? Well, usually in the academic literature, what they do is that they leverage or deleverage the index compared based on the volatility forecast. So to avoid leveraging the index, what we do is that we use a cap weight overlay that can be replicated by futures. So you are always invested 100% in the multifactor index, and then you will have a long or short position in this cap weight overlay. So we need to determine three different elements to apply HVA. First, the targeted volatility. So we use the historical volatility of the underlying multifactor index. We rebalance the allocations to the cap weight overlay potentially every week. So every week we forecast the volatility over the next week. And if the allocation to the cap weight overlay is above a threshold or a buffer of 13%, we will implement the new allocation. So we have this buffer simply because we don't want to change the allocation to the cap weight overlay based on noise. So we require a strong change in the cap weight overlay to implement the new allocation. And the allocation to the cap weight overlay is simply the ratio of the target volatility adjusted by the forecasted volatility. So it means that when the forecast is above the target, you will short the cap weight overlay, and vice versa. When the forecasted volatility is below the target, you will be long the cap weight overlay to increase the risk. So now let's see the benefits over the long term. So the period is from 1974 to 2019 on the US long-term track record universe, which is a long-term universe that we use for assessing the benefits of our strategies. And we show three main benefits that we discussed before. So first, the conditional dissymmetry. So you see that in the second column, you have the standard multifactor index without any risk control options. And you see that the market beta is quite similar between low and high volatility market regimes. But when you use the risk control options, HVA, you see that you have this dissymmetry in the market beta. In low volatility market regimes, you have a strong market beta, more than 1. And in high volatility market regimes, you have a reduction of market beta to 0.6. Then when you look at downside risks, well, you have a reduction of maximum drawdown from 51% for the standard multi-factor index to 31% for the one with the risk control options. And you can reduce also what we call worst rolling return of a 1 year or 3 year rolling window that you can also improve compared to the standard multi-factor index. And finally, when we compare the risk-adjusted performance on this period, you see that you have an improvement of Sharpe ratio from 0.71 to 0.76. So these are the three main benefits of this risk control option. Now, when you look at 2020, during the first semester of this year, so we compare the cap weight index, the multi-factor index with no risk control options, and the version with the HVA risk control options. And we focus on volatility or risk measures, which are the focus of the risk control option. You see that during the first semester, we have, for the multi-factor index, we have roughly the same volatility as the cap weight index, slightly higher max drawdown, and a slightly higher maximum loss, and the same market beta. So you see that during the crisis, the multi-factor index had the same, if you want, risk as the cap weight, or slightly higher. Whereas on average, we discussed at the beginning, you observe that multi-factor strategies tend to have lower market beta than the market. Well, when you use the HVA risk control options, you see that you can reduce strongly the average volatility, the maximum drawdown, and the maximum loss, which is the result of the strong reduction of the market beta over the period. So what we want to conclude on this risk control option is that if investors care about maximum loss, maximum drawdown, which are absolute risk measures, they should explicitly try to control for this risk by controlling for the volatility risk. Because when you focus on average measures like average volatility over 10 years or 20 years, it's not the right way to assess the extreme risks. And so if you want really to be defensive when the market crashes, then you need to explicitly control for this via specific risk control options. So obviously, when you use HVA, you generate huge tracking error compared to the cap weight index. So the option is not designed for investors that need to have very low tracking error. It's really designed for investors that cares about protecting absolute loss or absolute drawdown. Thank you for your attention. Serene, I'm done.
Thank you. Thank you very much, Daniel, for your presentation. I believe there is no question. So thank you to you all for your time. I wanted to advise you that we will be sending you the materials and the recording of this webinar very shortly. And in case you have any additional questions, please don't hesitate to email us at webinar@scientificbeta.com. So thank you very much, and we will now end the webinar. Thank you.